Good morning. Ed Yardeni here. Let me turn down the lights a little bit. Looks like this thing's pretty bright. Okay. Good morning. I hope you all had a great holiday season with your family and friends. I hope you stayed healthy. We had a good holiday season, but I managed to get COVID before Thanksgiving, as I mentioned before. And then after Thanksgiving, I managed to get something called RSV, which is just a really bad cold. But then I got hit with pneumonia. So I don't know who I could blame. I'd like to blame the Chinese Communist Party for having started all this viral stuff. Now, obviously, China is going through a pretty horrible wave of the pandemic, but we may be done with COVID, but COVID isn't done with us, or these viruses aren't done with us. So grin and bear it. I'm recovering. I still get a little fatigued, so every now and then I take a good nap, and that seems to do the trick. But again, I hope all went well for you. It was a tough season in terms of the weather. The blizzards hit just when everybody was trying to travel. So I hope you didn't get stuck in some of that travel issues. But let's talk about 2023. Happy New Year to everybody. I think we're all hoping that it's a lot better than 2022 was. That was a miserable year. But the consensus seems to be expecting that 2023 will be another miserable year. There's some talk about, last year was the really bad year for the financial assets. This year will be a bad year for the economy, which will be bad for some financial assets like stocks, but might be okay for the bond market. A lot of talk about a recession, and I've said this before, and I'm not the only one saying it, that if a recession's coming, if it's going to be imminent or it's going to occur sometimes in 2023, it'll be the most widely expected recession of all times. That doesn't mean that it can't happen. The fact that it's so widely expected actually increases the chances that we'll talk ourselves into a recession as everybody kind of hunkers down and prepares for a tougher 2023 business-wise. That could very well, I suppose, cause a recession. But on the other hand, recessions usually aren't that widely anticipated, and they typically get preceded by tight monetary policy. We'll check on that. We have tight monetary policy, but tight monetary policy then leads to an inverted yield curve. Check on that. We've also got that pointing towards a recession. Leading economic indicators tend to decline, which is what's been happening. So far, it certainly looks like we're heading into recession. But, one of the leading indicators is the stock market, and it has a record of anticipating a recession by 5 months, so a recession's overdue, according to the stock market. The leading economic index has a record of anticipating recessions by about 12 months. So that's kind of worrisome because it peaked in February of last year. So that suggests that the peak in the business cycle will be this year in February, and a recession will start in March. So we're not going to have to wait too long to see whether the LEI is working as a forecaster. But again, it's an average, and I guess it could happen later than March. We'll see. We'll all be looking at this together. But what is different this time so far is that tight monetary policy, and everybody knows this has been the most rapid tightening of monetary policy we've had since Paul Volcker had to deal with inflation in the late 70s and early 80s. And yet, despite that, we're not seeing a credit crunch. We're seeing financial crises, the crypto market, the SPACs, the ARK stocks. There's been a lot of financial crises, but none of them really have morphed into economy-wide credit crunches, which historically is what's caused recessions. Again, we could talk ourselves into a recession. You get a lot of very smart people, business people, financial people, economists, strategists anticipating a recession. Jamie Dimon has observed that consumers are in good shape now, but once they run through their excess savings, watch out, we're going to have a consumer-led recession, and he reckons that's going to happen in the second half of this year. So there's certainly credible stories to be told with regards to recession, and we're certainly not dismissing any of them. As a matter of fact, while we're still in the soft landing camp, we assign that a 60% probability. We're still given a pretty significant probability to a hard landing at 40%. Let's look at some of the charts that are relevant to the story that we developed in the morning briefing on the recession happening or not happening, hard landing, soft landing, or no, how about a no landing? You might recall, I mean, I guess some of the forecasters would like to forget this, but there were some calls out there saying that we were already in a recession in 2022. Now, of course, real GDP did decline for 2 quarters in a row in the first half of last year, but they were very minor declines. I will not be surprised if they get revised to show positive numbers, but in no stretch of the imagination is the National Bureau of Economic Research Dating Committee going to call that a recession. So we really haven't had an official recession in 2022, but here we are in 2023, and we've got more people more convinced that it's going to happen. Well, again, it's not as though there isn't any data supporting that kind of forecast. As I mentioned, here's the leading indicators. That's the red line. The red line peaked in February. It's down about 5% since then. It's got a pretty good track record, a very good track record since really the late 60s of anticipating recessions. Here you see it's peaked before the recession, bottomed pretty close to the end of the recession. Ditto, same here. This was a complex of recessions, but it did a pretty good job there. So you can see it does pretty well. This is the index of coincident economic indicators, and really it's the best monthly indicator of where we are in the official business cycle. And you can see that in November, we actually had an all-time record high in the index of coincident economic indicators, but that doesn't really mean anything. What the question is whether this drop in leading indicators will soon lead to a drop in the index of coincident economic indicators, which includes 4 indicators. One of them is payroll employment, which still looks pretty solid. We'll get a reading of that on Friday. Industrial production looks kind of toppy, all-time record high a couple of months ago, but it's kind of sideways for the past couple of months. Real personal income, inflation-adjusted personal income, employment is strong. Real wages have been flat until recently, but personal income has gotten the lift from employment. So all in all, it's still at a record high. And then there's something called inflation-adjusted manufacturing and trade sales, business sales, if you will, includes retail sales, wholesalers and manufacturers. And that's also at a record high, but looking a couple of months ago and looking a little bit toppy. So we'll be watching the coincident economic indicators for sure. Again, I mentioned that the S&P 500 has a track record of anticipating the recessions as well, and it does so with a shorter lead time. We average these things together. You can see it's kind of all over the place. It's been 12, 10 months. This was a -1, 7, 2. So there's no just because the average says 5 months doesn't mean that it can't be 12 months or 10 months. And if that's the case, it peaked in January of last year, so we should be peaking right here in January and seeing a recession coming up rather shortly. The interest rate spread is a component of the leading indicators. It's the spread between the 10-year yield and the federal funds rate. A lot of people prefer the 10-year minus 2-year because the 2-year moves the federal funds rate is administered by the Fed, and it tends to move with a lag, and the 2-year tends to anticipate where the Fed funds rate is going to be quite well over the next 12 months or shorter periods. And as you can see, it's quite inverted. It inverted in July. Now, the point of this chart is to show that inversions tend to occur at the tail end of monetary tightening cycles. So this inversion, if this is correct, and it happens again, we're pretty close to the end of monetary tightening according to the history of this yield curve picture. That being the case, it suggests we're closer to the terminal rate, which I reckon is 5.25%, which is what Fed officials indicated is where they think they want to get to be restrictive enough, and then they want to keep it there for a while. So that really implies this year in the first 3 meetings of the FOMC, 25 basis points per meeting would get us to 5.25% on the top end of the range. It could be 50 and then 25 and then a pause from there. But that seems like a plausible scenario at this point. There are other concerns about a recession. In addition to indicators that suggest that it's going to occur rather soon, there's a concern that maybe the economy isn't landing. The real GDP was growing pretty solidly in the second half of last year. The consumers didn't cave in. They spend more on services and a little less on goods. Capital spending kind of stayed in there. The biggest areas of weakness was single-family housing, not multifamily. That's been pretty strong. There was some weakness in structures and non-residential structures, though some of the data this morning looked awfully strong, particularly for construction of manufacturing, transportation facilities. But the concern is that, okay, let's say we're not going to have a recession. The economy is still doing pretty well. And in that scenario, inflation might remain troublesome. If so, then forget about 5.25%. It's going to be higher than that, maybe 6. Take your pick. What is it going to take? Whatever it'll take. Be kind of like Volcker. Volcker just let interest rates, markets determine what interest rates it would take to bring inflation down. So they soared and caused a credit crunch, caused a recession, and brought inflation down. It's conceivable that the Fed might be in that same situation where inflation doesn't moderate enough to satisfy them and to indicate they're going in the right direction. So they'll have to raise rates a lot more. Another part of that inflation story is China. It's hard to read how China plays out, but as you can see in Figure 5 here, the China situation is such that because of them giving up on zero COVID, there were just too many protests, so the government caved in, which I think was a very interesting development and could set the stage for ongoing protests now that people have figured out that if enough of them protest, the government will listen. But the government did listen. They gave up on zero COVID, but now COVID's running rampant in this latest wave of the pandemic in China. And as you can see through December, that's really depressed manufacturing, more so non-manufacturing, and particularly services in China. And that could be actually deflationary for the global economy. But if you're in the inflation camp, you can read that as saying, well, we're going to have another round of supply chain disruptions, and that's going to be inflationary. We'll be watching energy prices, of course, and this is the energy component of the Goldman Sachs Commodity Index. And you can see that peaked last summer. It's come down a lot, but energy is, as you can see, is a pretty volatile sector to try to forecast prices. Look, for example, natural gas. There was all this fear that Europe would run out of natural gas during the winter, and instead they're at 95% capacity on natural gas storage. Natural gas prices have come down dramatically there. They've come down quite dramatically here in the U.S. and oil prices have come down. But it's a very tough commodity area to forecast because geopolitical issues become concerning every now and then. But I think with China's latest round of COVID likely to depress economic activity, I think energy prices remain relatively low. And by the way, meanwhile, the United States is still a net exporter of energy, especially natural gas. But even we export crude oil on a net basis. I've covered this topic in the past for you. And so I think the market, despite government opposition, despite green policies by governments, a lot of governments have come to realize that we still need fossil fuels, if nothing else, as a transition source of energy. And certainly if solar and wind, for some reason, don't work, it's sure good to have fossil as a backup. So governments are starting to change their tune about completely eliminating fossil fuels, I think. But we're expecting energy will remain relatively quiet around this kind of level. If you let me change that forecast in case it just doesn't work out. Look, another concern here is monetarists seem to be making a comeback. You may have seen some economists, strategists pointing out that M2 growth M2 has stopped growing, and what a calamity that must be. They'll go back and say that hasn't happened in decades. Well, you know, we also didn't have a pandemic like this in decades that led to a huge surge in M2, as you can see in this chart. And if you extrapolate this blue line for M2 to about here in November, the conclusion is that M2 is still about $2 trillion above its pre-pandemic trend line. So I don't see what the big worry is about this thing being down only 1.8%. Meanwhile, if you look at one of the components of M2 is demand deposits, and look at this. I mean, it's absolutely soared. I think it's about a $3 trillion increase since the pandemic. So I think some of that is excess savings, and I think some of that is precautionary balances. Been kind of a crazy time since the pandemic, and people may just want to be more liquid as having precautionary balances. And by the way, I mean, it's amazing to see deposits up like that when the banks still aren't paying much at all on deposits, if anything, whereas you can get 4 or 5% in the money market. So what else could it be but precautionary balances? I mean, it's very odd, but it is what it is. By the way, it leads to the conclusion that all this fear that liquidity has dried up is evidenced by the performance of the stock market and the bond market. That this doesn't jive with the actual liquidity that's out there. Here's, by the way, M2 on a yearly percent change in trillions of dollars versus personal saving. And so clearly the pandemic has had an impact on the amount of savings people have accumulated, and that's been visible in M2. One more chart here, two more charts here on this subject. One of our accounts asked me to kind of update my views on M2 because it's one of the stories that the pessimists are telling about the imminent arrival of a recession. But look at demand deposits as a percent of M2. M2 has never been more liquid. If you look at this chart, not never been more. It's never been more liquid than it was back in the late 70s when things were also pretty crazy. So again, I think there's still a lot of liquidity out there. We see it in the stock market every now and then when we get just one little bit of good news and the market decides to go up like the Dow goes up 700 points or 100 points on the S&P. And then reality sets in terms of the concerns people have about a recession, inflation, the Fed, and we reverse that. Here's M2 as a ratio of nominal GDP. Some of you may be used to looking at it a different way, which is as nominal GDP over M2 is velocity. I prefer to look at it this way because it certainly is a good indicator of just how liquid how liquid the economy is. And this suggests that the economy has something like almost a year's worth of liquidity if you look at M2 relative to nominal GDP. Well, let's go back to the inflation story because that is the story. It was the story last year. It's what's driving the Fed. And I think with the benefit of hindsight, inflation has turned out to be transitory. Can't throw anything at me because we're doing this by video. But if we were in a real meeting, I suppose some of you would immediately jump and said, inflation has been persistent. It has been when you look at the overall inflation rate, but look at durable goods inflation. It was the main leading. It was leading the inflation surge initially, both on a CPI basis and a consumption deflator basis, but it's come down really quite rapidly. And look, it's only down. It's only 2.7% for the deflator, 2.4% for the CPI. I think it's going to be zero and negative here this year, the way it had been in the past. Well, on the other hand, we've got non-durable goods inflation, also kind of looking peakish, but certainly remaining quite high at these levels. But there too, if food and energy prices just stop going up for a while, I'm not telling you you're going to be able to buy beef and eggs and chicken and milk a lot cheaper. I think if these prices just stay elevated at these levels, this inflation rate's going to come down, which is what it typically does, at least in this kind of period we've been in. Here, there's some people talking about kind of a repeat that this might come down, but then the Fed will ease again and create another inflationary surge. I'm not in that camp. Services is where we have the problem, and that's where inflation is definitely persistent. And a lot of that's because of the weird cockamamie indicator for rent. We know that current leases inflation rate has come down actually pretty sharply based on apartment list and based on Zillow. But this is going to take a while, and probably by the second, I mean, there's no sign of a peak here. I think by the second half of the year, this will peak, and we'll see that moderating. So I still think inflation is heading down to 3 to 4% this year, which is enough progress relative. The Fed would like to see inflation down to 3% by the end of the year. I think that's possible. They are talking about getting it down to 2%, but I think they're pushing it out. They're pushing it out to 2025. So I don't expect that the Fed is going to be continuing to tighten just because inflation is down to 3% by year end and not down to 2%, as long as we're heading in the right direction. By the way, we also like to look at the 3-month percent change annualized in the various measures of inflation. We do that every time these numbers come out. And you can see the PCED inflation rate on a 3-month is 3.6 versus 4.7 year over year. So that points to continued moderation in the PCED core. The durable goods inflation rate 3-month is actually minus 3.8. Again, I think it's going to be minus on a year over year basis in coming months. Non-durable goods, let's make it core, excluding food and energy. That's not too bad, 1%. Versus 3.8 year over year. And again, this is where we have our problem, but I think that will moderate. And Fed officials have made it clear they understand the problem with rent inflation, and they've actually kind of created a new index of services excluding housing, and we're watching it, they're watching it, we're all watching it. So what's the argument for the economy continuing to grow and perform well? Well, it's all about the consumer. And I do think employment gains are going to slow, and that will help to satisfy the Fed in terms of reducing demand for labor relative to supply, though there are shortages. There's been a lot of hoarding going on, and maybe we're going to see less hoarding. But another important factor is real wages, and average hourly earnings divided by the consumption deflator has been stagnant all well, for about a year, well, since the pandemic, really. It's started to edge up here. Maybe you need a magnifying glass to see it and to believe that this is going to continue to move higher. But I think this is a year where wages can in fact rise faster than prices. That doesn't imply an improvement in productivity, which was awful last year. But I do think that companies are going to be increasingly focusing on recognizing that labor shortages are chronic and they have to work on increasing productivity. And I think we'll see more of that in real wages. And that's what supports consumer spending. Every now and then we get a retail sales number that disappoints. But again, keep in mind, consumers have pivoted from spending on goods to spending on services. This is the spending on goods in real terms. This was a trend before the pandemic. So it's quite conceivable that this thing will remain fairly sluggish until it catches up with that trend. Meanwhile, the services inflation-adjusted numbers are at a record high and will likely continue to move higher. Housing, we know there's some pessimists out there saying housing is in a terrible recession. It's always been the epicenter of economy-wide recessions. It'll have a lot of spillover effects. And there's a lot to be said and be concerned about that. But I would point out that multifamily starts remains very strong, while single family has come down. And we are seeing that people are still continuing to spend on home improvements. I guess, if you've got a house with a reasonably low mortgage rate, that's a disincentive to move to trade to a bigger or smaller house with a higher mortgage rate. So why not fix up the place a bit? So I think that's kind of a rolling recession rather than an economy-wide recession. Capital spending, we watch the regional capital spending indicators for the kind of the closest look at what's going on with capital spending. And that's been moderating, but still remains positive. And capital spending still looks pretty good. And by the way, construction expenditures came out today. And as I said, spending on manufacturing and transportation facilities was at an all-time record high. Let's wrap it up with another reason to believe the economy is going to grow rather than fall into a recession, maybe a soft landing, but not a hard landing, is that here's what the government spends in real GDP terms on goods and services. This is income redistribution, which is what the government did a lot of over the past couple of years. Now, with all these bills that the Biden administration has passed for spending on infrastructure, semiconductor plants, onshoring, and so on, I think we can expect that federal government outlays will start to increase, as will state and local government outlays start to increase. So we ran through a lot of charts here. We've got some questions. Let me go there. Let me first have a little bit of a whistle. What the whistle? I did have while I was recuperating, I did have some quality time to play chess with my son, and it so far in all the games we played, it's been a draw. How much did your vendor? I don't want to answer that question. It's off the record. This is something about the ransomware, so I'll pass on that. Russ, the yield curve as an indicator is a concern, since, by the way, I don't know the answer to Michael's question, so all the more reason to skip it. Russ, the yield curve as an indicator is a concern, since we are all aware that the Fed has distorted that market through their massive holdings of duration. If the Fed wasn't holding a bloated and duration-filled balance sheet, what do you think the yield of the Treasury 10-year would be today? That's a really good question. I'm going to have to think about that a little bit, because like everybody else, I've believed that since 2009 until this year, the bond market was being rigged. So it really wasn't giving us much of a proper signal of what market forces really were doing. But I guess I've been working or thinking under the assumption that the bond market now can express an opinion, and that it is reflecting market expectations, so that the yield curve is actually a good market signal. But I guess what you're suggesting is if they didn't own all those bonds, the bond yield would be a lot higher. I don't know. I mean, we also know that the Fed's engaged in quantitative tightening now, which means that they're selling the bonds. So that would mean that I don't know. I'm getting myself into a box here. I'll think about it a little bit. Ralph, at this point, I'm my inclination is the yield curve is still working as an indicator. Ralph, consumer debt is skyrocketing. Isn't that a good indication of an upcoming economic storm? I mean, relative to overall consumer spending, it's not skyrocketing; it's going up. And relative to personal income, it's going up. But I've got now two things to address in my morning briefings next week, over the next few weeks, I should say, and I'll address both those issues. The concern about what the yield curve is actually saying, and the issue of consumer debt. Raphael, would the M2 buildup be associated with business checking accounts or sole proprietorship deposit accounts due to PPP? Few business owners relative to working population. Could this significantly distort your overall deposit trends? I mean, all good questions. Ever since the pandemic, everything's been distorted. So I'm aware of that and try to not overstate my case on any of this stuff, given how things have become distorted. But it's hard to say who actually is holding on to those deposits. I suppose it could be businesses, but again, they are run by business people who have some understanding of financial markets, and I think they could very well be putting their liquidity in treasury, short-term treasuries or money market funds rather than in demand deposits. So it's I don't have an answer. I don't have the data, but another subject for me to explore with my team. Gus, if the Fed maintains rates at a higher level for a longer period of time, do we need to re-rate interest rates going forward? Well, I guess one of my theses is that and I think it's pretty obvious that that the new normal is over. The new normal was what was the environment was called back from 2009 through 2021. And now we're back to an old normal where inflation is more of a concern. Central banks are raising interest rates. Interest rates are getting normalized relative to what they were before the new normal. The question is whether at interest rates of 3, 4, 5% in the U.S., whether the economy can grow. If it can, that would just be, again, a sign that the economy is resilient enough to withstand interest rates that were associated with the kind of growth that we may be seeing up ahead here. So I'm kind of rooting for that. I'm hoping that we are kind of going back to the old normal where interest rates aren't zero. They're more normal at 3, 4, 5%. Inflation may not be 2%, maybe 3%, but nominal growth is better, and nominal growth is based more on productivity. I don't think we should dismiss that as a possibility for where we're heading, and it's kind of consistent with our 60% soft landing scenario. Well, let me see. I think there's one more here. Oh yeah, Happy New Year. There's much more. Yeah, there's much less negative yielding debt. Yeah, maybe less negative yielding debt is a healthy sign. But again, thank you for reminding me that I should wish you and everyone here that joined us here a very Happy New Year. We had a very nice crowd. Thanks for turning out on this first trading day of the year, and I'm sure it'll be an interesting year, as was 2022. Just hope that it's a lot more fun. Thanks, everybody. Stay healthy.